And yeah, I have been around for a little while, but time goes quickly when you're having fun. So today I'm going to talk to you about the regional syndicated loan markets. And they are big markets, and there are large volume transactions that are done. So I'm going to contrast what's happening in Australia and New Zealand to Asia Pacific, and then I'll show you where we rank in terms of the rest of the world. So in terms of activity, last year the volumes were on par with 2012, and we had a number of transactions and they were up 30% on the 2012 numbers. So there was 192 transactions done in the syndicated loan market versus 148 in 2012, and that's excluding bilaterals, so it's clubs and syndicated loans. So if you look at the chart down at the bottom, you can see there that the US volume was 107 billion. The Australian volumes of that were 93.2 billion US, depending on which source you look at. So we've used Thomson Reuters. If you look at Bloomberg's, it might be slightly different. So contrasting that to 2012, we were slightly down, but in 2012 you had the big transaction for the Ichthys LNG deal. So that was $20 billion US. So looking at last year, the volumes raised were substantial. In the first 3 quarters, the domestic banks were the major players. The final quarter, we started to see the international banks coming back and being more active in building balance sheet. And in just December alone, there were 46 deals closed for $24.5 billion. And they included some large transactions for Lendlease, Charter Hall, Cbus, Ramsay and Energy Australia. So those transactions were done where borrowers were starting to look at where pricing was going and wanting to get in before the end of the calendar year to raise funding. We're continuing to see debt funding diversification, so the volumes there have been strong. Increased investor appetite for low investment grade credits and longer dated tenors for 7 years and beyond, as we've talked about in the last 2 speakers. And pricing, the margins have continued to tighten given the abundance of liquidity that we are seeing from the banks. I've also put in there the volumes year to date. So year to date we're at 11 billion, and one of my colleagues in New Zealand delighted in telling me yesterday that New Zealand issuance in the syndicated loan market is ahead of Australia. So they are doing some big transactions over there. So they're at 6 billion, we're about roughly 5 billion. So we'll see where we both end up at the end of the year. So in terms of Asia Pacific, so this is excluding Australia and Japan, again, robust activity in 2013. Year-to-date activity remains strong. A lot of cross-border M&A will continue to drive growth in the region, and corporates from China, India and South Korea are looking for growth outside Asia. Again, strong liquidity. Minor hesitation over the slowdown in selected emerging markets, particularly in India and Indonesia. And you are seeing, the Eurozone and the US banks coming back to play a more significant role in Asia in 2014 and an increasing liquidity pool. So pricing tightened in Asia throughout 2013. Average tenors have lengthened beyond 3 years. However, there has been some the tapering with the US and other central banks may put upward pressure on loan pricing going forward. So we're seeing a bit of that with the Taiwanese banks at the moment in terms of their cost of funds. In terms of pricing, we saw one particular client in the Asian market last year go to the market 3 times in the syndicated loan. So they raised money earlier in the year, they came back and did another transaction with the Taiwanese banks, and there was another deal we closed with ANZ in the last quarter of last year. So that was their 3rd venture for the year, and each time they were managing to decrease their pricing. So 363 billion US, excluding Australia and Japan last year. Year to date, 103 billion. So contrasting that with the volume, so you can see there China is up there with substantial volumes, and previously, I guess in the last probably last 3 to 4 years, you would have had Australia as the leading syndicated market, but China is more active in terms of, and they've actually got regulations as to when they can call a loan a syndicated loan. So you are seeing more activity in that syndicated space in China. Hong Kong, that's also grown in terms of size, and you can see the other respective markets there in terms of their size in the region. Where do we rank globally? So this is narrowed down to Asia Pacific, Japan, Europe, Middle East and Africa and the Americas. So you can see that Asia Pacific, where that pale blue bar up on the corner there, so we, compared to the rest of the world, Asia Pacific wise, we're not as large, which is expected. In terms of just looking at what were the dynamic industries last year in terms of the syndicated loans, so property, infrastructure, energy and power, they were the most active industries in 2013. They are, in my time in the syndicated market, they are usually the most active. We are seeing more infrastructure coming through, but property and energy and power have been very active, and also in the past in the natural resources space, so particularly last year with some of the LNG deals. In terms of New Zealand, 50% of that volume was coming from healthcare, media, telecommunications, property and construction. So you can see there the pie chart as to where most of that is coming from. In terms of distribution, overall club facilities remain favoured by the loan market, so they accounted for 58% of the volumes. So that's where you have might have 2 to 3 to 4 banks coming into the transaction. Syndicated transactions were dominant where large volumes were targeted and for non-vanilla transactions. So there were quite substantial deals that were done in the market, for example, the Origin Energy deal, which was actually underwritten. Of the transactions larger than 500 million, 26 of those were syndicated deals. And we saw continuing appetite from banks to underwrite. So this was critical for acquisition type deals, other event-driven deals, or when we had borrowers who were looking to refinance quickly. So some of the underwritten transactions included M2, Horizon, Link Market Services, Origin Energy and Energy Australia. Some of those transactions, for example, the Link transaction, they looked at the US term loan B market and they looked at the domestic loan market and they evaluated and came with an underwritten transaction in the first half of 2013. In terms of purpose and tenor, so we can see that refinancing was the key driver as corporates looked to take advantage of favourable loan market conditions and bringing forth upcoming maturities. So with pricing where it was, people sought to take advantage and refinance their 2014 and 2015 maturities. We also had some large infrastructure projects. For example, Aquashore had completed the construction of the desal plant and came early and refinanced that loan into the debt capital markets and also into the bank market. So refinancing activity represented 72% of 2013 volumes compared to 55% in 2012. And typically you see each year around the 50 to 60% mark in refinancing as borrowers come back to the loan market to refi. But last year it was a very large percentage that was done. In other purpose was acquisition. So you had the sale of Port of Botany and Port Kembla, which was financed by stretch clubs in the market. So that's where the borrower organised a whole range of banks to look at those assets. So you might have had 3 to 4 bids, and you had banks in each of those bids, and some banks were working on multiple trees on those transactions. You had QIC's acquisition of Moomba to Adelaide Pipeline and the IRS acquisition of Avalo financial services. So acquisition activity was picking up last year, and we expect that to continue this year. The project financing, so there was a number of wind farms done, and the largest project financing was the Sydney Convention Centre, so that was 1.6 billion, so that was the PPP. And compared to last year, we didn't have as many project financings, but we had the big ones in 2012, which was the ICFIS and the APL LNG deals. So just turning to tenors, so tenors trended back towards the more traditional 3 and 5 year terms. In 2012, we had the project finance deals, so those LNG deals, so they were 16-year amortising deals. So they pushed the numbers out. So if you can look at that graph at the bottom, you can see there the big spike in greater than 6 years. That was mainly those LNG deals. We have seen, yeah, that's right. We haven't seen as many deals in those longer tenors. There have been some which have been structured 3, 5 and 7 year transactions. So the 7 year pieces in the bank debt have been, not all banks can play in that space. It has been limited to half a dozen banks. In Aquashore, the banks came in, they all joined in, so they did a bit of 7 years. But it's not for everybody's cup of tea to do that 7 year piece. So but we are seeing small tranches of that in some of the syndicated facilities. So 3 and 5 year volumes was 62% of the volumes raised. 4 year was popular also as borrowers sought to sort of extend slightly beyond the 3 year tranche, because what you see is borrowers, when they come back to refi, they'll look, I think S&P have the requirement at 6 months before maturity. Some borrowers will look 12 months out, and if pricing's on a downward trend, they'll go out further and look to refi early. And bridges, well, there weren't as many bridges last year because there wasn't as much M&A, and the tenors were going beyond 12 months as borrowers thought to go a little bit wider, just in terms of the making sure they had the certainty to refinance those bridges. In terms of pricing, so we've contrasted that with Australia and New Zealand and also the Asia Pacific. So margins have continued to tighten off the back of the liquidity that's coming through. We're seeing front-end fees are steady, but in Australia they're lower than what you would typically see on the Asian deals. The all-in cost of loans have fallen to 6 years lows, with an average BBB equivalent rate of borrower accessing the market at just under 4%. So you can see there's a graph there which is showing from 2008 to 2014 the all-in costing for a BBB borrower, and how the margins have transpired over those years. Commitment fees are typically 50%. There has been some pressure to reduce those, but we are seeing most borrowers at the 50% level, and that's where the banks are needing those levels for their capital requirements. And in terms of the generic pricing curve for 5 years, I've shown that there, and you can see how that's trended down since March 12 to September 13. Contrasting to Asia Pacific, again, pricing has tightened. Banks remain well capitalised with good funding access. There is increased competition, so banks wanting to strengthen balance sheets caused by the shortage of supply has resulted in downward pressure on pricing. And pricing remains at a premium for crossover credit. So crossover credit is a client that would be moving some sub-investment grade to investment grade. And the appetite remains on the shorter end for those tenor durations. So investment grade borrowers are gradually deviating away from 3 year tenors in the Asian markets, and they're looking for more 5 years with moderate pricing premiums. So you can see there on the graph below. In terms of investors, we are seeing the domestic majors. They have continued to be the largest source of financing for Australian borrowers, so supporting the relationships and building the balance sheets in a subdued credit growth environment. We have seen the international banks becoming more active in Q4. So we are seeing, particularly some of the French banks, they're looking to put on assets, and they're coming to the banks and saying, what assets have you got that we can start to rebuild our books, to start them off and build their budgets for the next year. European banks have generally been selective during the period, but they are, as I mentioned, they are looking to support core relationships. The Japanese banks have been strong, focused on investment-grade corporates and also project financings. We're seeing the Taiwanese banks, they've opened up branches domestically, so they are focusing on this market. The institutional investors and also some of the credit funds are focusing on the syndicated market, as Mark mentioned before. So we've given the percentages of what's coming from the different regions. In terms of the other, you're seeing the Chinese banks are in that other group there. So they were a bit more subdued last year in the market, but we expect to see more of them this year. So on the Asia Pacific side, the Chinese banks have been definitely strong in their own market. They've seen increased deal flow in Hong Kong, and they're supporting their Chinese borrowers and also the Hong Kong subsidiaries as well. The Taiwanese banks continue to be active. However, they've got the increasing cost of funds resulting in them being more selective. But typically for a Taiwanese bank, you might find $5, $10, $15 million, $20 million parcels. Some of the banks will look at 20 to 50, and we have seen some of those, but typically they are smaller ticket banks. The Japanese banks are continuing to be strong in the Asia-Pacific region. The Singaporean banks supporting their borrowers, and the North American banks are coming through as well into Asia. And we're also seeing the Middle Eastern banks coming through. There's a transaction that we've been working on, and there is Middle Eastern interest there as well. In terms of debt maturities, so over the next 3 to 5 years, our estimate is $183 billion. And we expect corporates to continue to refinance debt maturities early whilst loan conditions are favourable. So the refinancing task is manageable with the international banks coming through and also with the capital markets open for business, and that's providing greater funding diversity for clients. So we've set up the debt maturity profiles there so you can see the volumes coming through. 68 billion, 65 billion in 2015 and 16, and the various industries that you can see there. So typically property and construction, the metals and mining, and also the utility sectors are strong refinancing candidates for the coming years. Last slide. Okay, so in terms of the outlook, the message is there is strong liquidity. It's continuing in the regional syndicated loan markets. Corporate credit growth is expected to remain subdued, so we haven't seen corporates doing as much new money transactions, despite the strong balance sheets from lenders. So we encourage people, borrowers to look at all the markets and look at where they can grow for new growth, as opposed to just doing refinancing transactions. M&A, that's expected to perform better in 2013. Other event funding, so we're seeing more IPOs coming through, particularly from private equity, which is requiring that the existing private equity deals are refinanced on more attractive terms. Use of underwriting is continued for event-driven transaction and critical refinancing deals, so more underwriting is coming through. Project finance will drive new money volumes, and there's the upcoming PPPs in North West Rail, Northern Beaches, Perth Stadium and Transmission Gully in New Zealand. And debt market conditions remain favourable across all markets. Again, Asia Pacific, strong momentum. Chinese companies are expected to continue their expansion acquisitions in overseas markets, and they'll have strong funding needs. And Southeast Asia, India continue with some financial volatility. So that market will continue. We'll watch that with interest. And generally, overall market liquidity across Asia is strong. Pricing is stable, and we'll watch what happens with Basel III regulations and how that impacts going forward.